Let's talk to Tim Gregory, the Chief Investment Officer at Vermeer Investment Management Limited. That's a tongue twister for Monday morning. Morning to you, young Tim.
Morning, Nick.
Right, let's steal something out of the FT. The non-farm payroll on Friday, we had 313,000. We had wage inflation, very gentle. We've got Goldilocks being talked about. Then we've basically seen an S&P on course for a weekly gain of 2.8%. Tepid wage growth, and then we've got Donald Trump meeting North Korea. This is Goldilocks stuff, isn't it?
Well, it was a very good week for the market, and came, after a slightly tougher period, obviously, since we last met, actually.
Yeah.
So we kind of got back to where we were.
Well, we haven't taken out that old.
No, but we got back to where, when we were chatting a couple of weeks ago, markets had a good run, and then they came back, and then, as you say, sort of combination of things last week. The North Korean news, some slightly softening on some of the commentary surrounding fears of a trade war, which had put the market under the skids the previous week. And then Friday, as you say, the Goldilocks jobs report, where jobs number came out ahead of expectations. And I think the number that people are looking at more now, the average earnings, was, as you say, tepid. So what are people looking for? Good growth, no wage inflation. And so, of course, that really set the market alight. But and not wishing to be,
cynical,
but there has been a beige book report, which is US economic report that comes out, which is always well worth looking at, and that does highlight a number of pockets of labour shortages, which suggests that just because this report was terrific, and we all know that one jobs report, we can see revisions to the data. We've had years of saying, oh, this was a terrible report, this was a great report, and then the next month the data looks completely different because there's been lots of revisions. But the report was excellent on the face of it, exactly what the market wanted, and better news from North Korea, slightly softening of the stance with respect to some of the trade tariffs that have been talked about. So it was a really good week for the market.
Okay, in terms of the trade tariffs, I read the US, I think, employ 142,000 people in the steel industry, but the knock-on effect, they hire 600,000 or so people in autos, and the point being, that the only reason he's talking about trade wars is because of the midterm elections in November, the feel-good factor for the blue-collar worker who's working in these suburbs. Is this, obviously, the textbooks would say this is disastrous, this could lead to worldwide recession, but is this just, dare I say it, Trump playing games?
Well, it's too early to say, really, and there are a number of angles to look at it from that. You draw attention to the midterm elections. You can also draw attention to the fact that the NAFTA trade agreement is also, coming up, and discussions around that. So who knows how that's all going to position itself. On the face of it, as you say, nobody likes to, fear the prospect of a trade war. There was some pretty, serious responses from European politicians, and obviously we'd expect a response from China if it did escalate into something more. So it's something for markets to have still in the back of their mind. And, we've had a very good run for a very long time. I know I keep saying that every time I come on, but that is the fact. Valuations are somewhat stretched, and people tend, when the news is good, to ignore that. And then, of course, when something occurs that begins to worry people again, those issues of valuation do come back into focus. For the moment, of course, the fact that the 10-year US Treasury yield has had this big move to nearly 3 and now has stopped, very conveniently for everyone for the time being, is exactly also what markets would have wanted to see, having had that shock when back end of last year they were broader nearly 2% and suddenly everybody discounting 3%. The question is, what happens next? And as I've said before, I think there are evidences of labour shortages. I would be surprised if in the next few months, somewhere along the line, there wouldn't be a jobs report or a set of inflation data or some retail sales that did spark some concern that there could be a return to inflation, and that would see bond yields push on through 3%, and that could
be a game changer potentially.
And that could set the markets back in. Of course, on the flip side of that, if, to your point, if people start worrying about a full-on trade war, and it isn't just political positioning, and it does really develop into something more serious, you see that people's fear then is that the growth is going to be impacted. then bond yields start to actually come back the other way.
Yeah.
And so I think that's kind of why we've stalled at the moment. There's a bit of a push and pulley between those two things at the moment.
Right. Finally, any changes in the portfolio in terms of themes, sectors? Are you still banks and commodities?
So that's been, as you know, a sort of newer theme for us, and we've stuck with that. We have had a big overweight in industrials since the portfolio was launched. We've just eased that back, actually,
Right.
which, of course, on the face of Friday's report, doesn't look the smartest thing we've ever done by any stretch of anybody's imagination. But we just feel that there are some valuations that have got really stretched relative to growth prospects. And one stock that we sold in Europe, actually, we've seen some results that have been good results, but companies saying that the strength of the euro is really impeding their outlook, not necessarily from a transaction perspective, but when their profits are translated back into euros, which have been strong from the dollar, that's flattening growth.
Right.
And actually, a number of stocks in Europe have had slightly, not so much disappointing results, but disappointing reactions to results, partly because if they're global businesses, the weakness of the dollar is impacting them.
Right. Tim, on that note, always lovely to see you. We'll see you in 2 weeks' time.
Thanks for your time.